All right, awesome, Daryl. Thank you very much. And let me just do a quick sound check. Make sure you guys are good to go. And yeah, Dale, that's a good point. In addition to, there's plenty of other webinars out there you could be on. There's plenty of podcasts you could be listening to, books to read, shows to watch, episodes of Yellowstone to catch up on, and the like. So we always appreciate it when you guys choose and gals choose to spend an evening with us. And and something like this, and then, I want to go through, it's kind of like this free presentation. And the goal with it, of course, is to present some knowledge that I'm finding that's critically important to these current markets. And then at the end of it, if you guys are interested in more, there'll be some info there. But I would highly encourage everyone just to kind of, just to at least understand the information that I'm going to get out there, just so you understand what's going on in the markets. And this is something where I've had a 3-day weekend where I went 100% cash in my major trading accounts because it's been a little lopsided market, a little bit frustrating. And I always find that when it gets like that, I need to clear my head, go for a walk, ideally go for a paddleboard, but I wasn't near an ocean. And I did have a lot of aha moments, and I'll just kind of dive into that. So I just want to show you some stuff, pretty simple, pretty straightforward, but critically important for understanding what's happening in this current market. So let's just kind of dive right in. First of all, current market action makes me want to sometimes pull the few remaining hairs that I have left out of my head. But as a trader, it is about learning to adapt, learning to make sure that we are, if you're dancing with the market, it's best to let the market lead versus like, wait a minute, trying to shoehorn a specific strategy based on how you think the market should go. And so I always like to call myself out on that too when I'm just kind of looking at things. So what's going on here? It's volatile. We've all seen volatile, but this is different. The markets are volatile, but the question is, why are they volatile? Well, sure, and I don't mean just volatile like, the obvious factor, like, oh yeah, because there's interest rate hikes and there's war. And as always, anytime we're talking about the markets, there's always bad news, right? It's just, I mean, because the news is always bad. The news wouldn't be in business if it talked about all the good things that happened today. So bad news is all over the place. But unlike other declines and volatility things we've seen, even March 2020, even 2008, those were very clean sell-offs, but the markets aren't going straight down right now like they would in a normal clean sell-off. And then the normal setups, and I'm talking about longs and shorts, obviously long setups are harder to make work in a downtrending market, but even the short setups are getting whacked. And they're getting run over by seemingly out of the blue moves in various stocks and indexes. And in fact, I would say that today was a great example of that. And, again, we're not talking just setups on the long side, but both long and short setups on a swing basis. Okay. So so the question really, what it comes down to, what causes this? And then, is it humans trading against each other? Which is an interesting kind of a concept, because as we're in the trading room and we're doing trades, some of us can be on opposite sides of a trade depending on the time frames that we're looking at, but that is not what I'm talking about. So there's two main things to think about here. First, there is a huge amount of money invested in the stock market by institutions. They cannot right click and get out of things when things aren't going their way, or they would crash the market. So what do? They are hedging. We've got record amounts of hedging happening, put options in the indexes, put options in the futures, VIX calls. It's bigger than it's ever been, and this has increased exponentially since March 2020 because the gains have been so big that everybody wants to lock those in. And while as retail traders we have the advantage of being able to right click and get out of a trade that locks in our profit, institutions do not have that same advantage. If they all decided to get out at the same time, they would drive it to zero, and they know that. So what happens is that this causes a lot of stock movement, not only when hedges are established or unwound, but also in the form of what's called gamma squeezes. All right, so what's a gamma squeeze? Well, the simplified version of that is gamma squeezes happen when traders overwhelm the market makers, forcing them to buy out or sell their positions, which can cause a stock or index to have a crazy move, seemingly out of the blue. GME and AMC are the poster childs of this, as they were the most extreme examples I've ever seen. But this does happen regularly with indexes. It happened today. And other stocks, with the most extreme moves happening into monthly and quarterly expiration. Okay, so that's one thing. But the other thing that started happening in this, and really started noticing this, it started happening much earlier, but I was a little slow to catch on and really caught on in January. I noticed that there was a whole lot more happening. So basically, yeah, no, it has been it has been frustrating, TQ. Yeah, it's always like, and usually it's like I always, yeah, I know the markets change, and it's like if anything, it's always kind of like I know that the easy moves last a couple of weeks. The only price you got to pay for sitting on a trade for 2 weeks is learning how to manage anxiety. But when the things like that just kind of stop working, you really want to take a look at it and say, well, is it the setup? Is it the time frame? Because oftentimes it's the time frame, but it's not just the time frame. And it's like, what is that extra thing that's happening here? So stuff like that, on the one hand, it drives me crazy when it gets frustrating, but it also, yeah, I feel like there's this drive to, I don't know, like this unquenchable desire to understand. And then once you understand, it's just like this big wet blanket that just drops off, which is great. So really what this is talking about is important levels as determined by machines. And I've been doing this a long time, and I have never seen the market this dominated by automated computer generated trading. I'm talking 2000, 2008, March 2020, you name it. Never, 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 never. Human activity is but a flea on the hide of an elephant in these markets. We are not noticed or even taken into consideration. Now, it feels like we are, but we're not. If we're experiencing any frustration, it's because we just don't quite understand. We're not dialed into the dynamics of the current sandbox that we're playing in. It's important to know that machines are unfeeling, unthinking, can analyze thousands of variables at once, and never need to take a break. Mechanical trading has evolved from a few lines of code about moving averages to having AI, which is artificial intelligence, analyzing and making decisions based on hundreds of inputs simultaneously over thousands of stocks also simultaneously. So the idea with this is once you understand that machines are controlling the market, there is really nowhere to hide, and it's like price is here, let's attack. And so it's important to understand that this action is being driven by computers, but more importantly, okay, what are they looking for and what are they doing? So let's talk about AI. And I've talked about this before. There's a company that I've invested in that trades 100% based on artificial intelligence. Now, I'm a very small investor in this company, but I was interested in it. They're based in Dallas. And I go and I visit these guys and I talk to them and we kind of swap strategies, but it became very clear early on that the type of trading we do is completely different. And what the AI does, believe it or not, AI can't do all the things that a human can do. They don't understand like a lot of the nuances and the squeeze and all that kind of stuff. But the main thing here is that they are trading with a $14 million computer. And I always kind of sit there and I think if I'm scalping or wanting to do a day trade, remembering that I'd be trading against that $14 million computer. And what does that mean? What does that mean to be trading against something like that that's unfeeling, unthinking, and incredibly, incredibly ready to go. It doesn't need to drink some caffeine. It doesn't need to shake off the last losing trade. It's literally a machine. So this particular one has 128 separate AI algorithms that scan for market opportunities, which are organized by a dozen manager AI algorithms. When I visit these offices in Dallas, I'm frequently checking my iPhone for quotes. What's the market doing? And the team there, which is hilarious, they never look at the markets. They don't even know what they're doing. I'm just like, oh my gosh. So this is what it looks like. This is basically, the back of the hardware and all that kind of stuff. And, you would think that there would be 30 monitors, but this is all run off of a laptop. And this is just a backup laptop. It's not even on. There are 5 separate AC units in here to keep this cool because it generates so much heat. And if you look at these floor panels that are taken out, there's 5 feet of space below to allow for air circulation. Otherwise, it would overheat. Okay. And then these guys, yeah, they're trading big money, but they don't use a ton of leverage. They do futures, they do indexes like SPX and stuff like that too. So they're not going crazy. They're going for like 30% a year, managing, a lot of money. but they are trading size. But also remember, this is just one firm. Okay, this just happens to be a firm that I'm acquainted with. I know the owners, and it's great to talk to them. But there's a lot of these that are out there. So, although humans cannot compete with AI, we are only human after all. Humans can trade with AI as long as we know what the AI is focused on. So I recently went back up to visit. I took a deeper dive into what they were looking for. And in truth, I thought it would be incredibly complicated, but I learned something. While AI is great, it does not understand nuances like internals and the squeeze and things like that. I think as humans, we're used to looking at the markets, and we can look at the RAF Pro and Voodoo lines and the squeeze and all these different things, and just kind of naturally see how things are setting up. AI doesn't do that. They actually tried it. They tried programming it. They're like, we just don't. It doesn't understand the nuances. However, where it is absolutely, absolutely superior, Stack. Oh, the name of the firm is Capital Logics. But where it is superior is in understanding what key levels are important and the probability of those levels holding. I'll say that again. It is superior in understanding what key levels are important and the probability of those levels holding. This drives where they take action. So these are some signs that they have around their office. And I'll show you, I've got a couple of slides of these intermixed. You can't predict random. Market forecast, algobot, trench warfare. If you don't know what your edge is, you don't have one. I love their signs. I mean, they apply to any type of trading, but it's just, they're really, really into this. So we are in the machine's blind spot. They are not, and I think it's important to understand this. AI is not attacking us. They are not seeking out our orders. And in fact, they don't even know we exist. They are merely responding to price. Our job is to understand what price actually gets their attention. And then what do they do once that particular price gets their attention? Okay, that's it. That's AI in a nutshell. They're just able to do it on multiple time frames across thousands of securities in an instant and never get tired. They don't miss opportunities. Whereas if we go get a cup of coffee and we turn, we're not, or we don't happen to be watching the exact chart, we can miss a move pretty easy. That doesn't happen with AI. So how do we really understand what they are doing and take advantage of what they are thinking or how they are responding? AI responds best to what it considers actual price anomalies and volatility, okay? And the reason I say actual, because it does not care about theoretical, which is a huge distinction, okay? Theoretical, or is things like expected move, is calculated by the options Greeks, right? That's all theoretical. It doesn't care about that at all. So it does, though, care about actual price anomalies and actual volatility, which it can track on multiple inputs, on multiple time frames, on thousands of securities, all at the same time. So are they selling their technology? So they don't sell their technology. I've asked them about that, but I did get, they thought that this was simple enough that they would at least give us the inputs for it. And we've done some stuff similar to this before, but it really hit home that there's something happening here and that we need to know. All right, so some more signs from their office. Confusion is a catalyst. I love this quote. A lot of times when the market is confused in what's happening, and they've told this to me, is when they thrive. AI is cool. AS, artificial stupidity, is scary. And I asked him what they meant by that. And that's the stuff like that is when they go, oh, when people get fearful of the news, those are our best trading days. Things like that. Artificial stupidity is scary. And they don't mean people. They mean that, the institutions and things like that create fear, that create stupidity, and, that kind of stuff. So what's interesting about all of this is that the AI fund does not trust humans. They do not let any of their humans trade. But it does trust the machines. They just think like, and it's funny, the main guys there, they're former floor traders, and they'll trade their own account, but they won't trade the fund. And they said the reason is humans can make mistakes. AI does not make mistakes. So the data points they use are limited, though far-reaching, since they can analyze, again, thousands of securities, indexes, and markets simultaneously across multiple timeframes. People who don't know about this are definitely getting taken advantage of, and I have been. And I'm going to show you guys some examples where I had a setup that to me looked textbook, but I got railroaded because at the time I was ignoring this and I was unaware and ignoring this. So people who don't know are definitely getting taken advantage of. I put myself in that category. And I certainly have had a few standard setups so mysteriously not work, especially over the last several months. This is what prompted me to visit their offices again. However, once I understood what they were doing, and remember, they aren't the only firm doing this, suddenly everything started to make sense. Um, so I think this is interesting too, because when we think about AI, we think about, oh, it's machines, but remember, it's all coded by humans. So the heartbeat of AI is still human. And then I love this: mediocrity is expensive. So it's just just an interesting trader sign that they have there. So here's the things I'm talking about. So do you know there are levels where if you go long or short at those levels, you have exactly a 7% chance of being right? Okay. This happened to me on a trade in Tesla back in January. I will show you that exact chart here in a little bit. So the question comes up, it's like, okay, if I see a squeeze that I like, but on the other hand, the algos are telling me that that's got a 93% chance of failing, is that something that I want to know about? And the answer is absolutely yes. That is something I want to know about. So that is what the machines are on the lookout for. And we know most traders, newer traders in general, lose money. But when any traders are kind of going through a tough time, it's always good to find a quantifiable reason why. Okay, and this is it. So it's not just computer versus, it's computer versus humans. It's computers are doing their own thing and they don't care about what the humans are doing. And so as humans, we want to know, how do we exploit this? So once you understand how it works, you can keep doing what you're doing or embrace it. And, what I felt like was being farmed by the machines, almost like, if you guys are familiar with the movie The Matrix, where they're farming the human bodies for energy, it feels like that sometimes when it's like, wow, why am I on the wrong side of this? And so that's what it felt like was happening to me. The good news is you're invisible to them and you'll continue to be invisible to them. Instead of accidentally trading against them, you can start trading with them. So they're not attacking us. They're not looking for us. They're not being mean. They don't even know we exist, is the thing. So they're like waves in the ocean, and we just need to recognize what these new waves look like and which direction they're going. So some questions that'll pop up with this, because we'll start looking at this pretty soon. Is it average true range? Is it expected move as calculated by the Greeks? Because those are both things that I look at. And the answer is absolutely not. AI does not care about theoretical levels, theoretical possibilities. They base everything on actual. And the reason they're able to do this, okay, versus taking a simple, oh, what's the expected move? They do actual because they can. Most of us can't. How do we look at Tesla over the course of 10 years and say, what's the actual average weekly high from the open and the average weekly low from an open over the course of 10 years? I don't know. AI knows because they can calculate it almost instantaneously. So the other thing is they also will look at things, and you'll notice that when we start looking at this is that some levels, they're not equidistant. If here's the center line, the up level, maybe 10 points and the down level maybe 25 points. If you're looking at average true range, if you're looking at expected moves, these numbers are identical, which is a huge flaw. It's a huge flaw for targets. It's a huge flaw for selling premium. In that case, you should be doing, say an iron condor. The iron condor in that case should not be equidistant. It should be much more room on the downside than there is on the upside. But that's not stuff we're going to get after, from average true range, and that's stuff we're going to get from expected move information. So the thing with AI is it can handle a lot of data, and that's why it's able to focus on the actual. So what do they like to look at? What are the daily ranges? Okay, what are the weekly ranges? What are the monthly ranges, and even quarterly and annual yearly ranges? In addition, they can go intraday and look at 30-minute ranges as well, and mix and match 2-day, 3-day, and 4-day ranges. Okay, so that's the kind of thing that we're up against if we're not aware. So what do these levels represent? A move outside the norm of actual price action. Okay, and this takes into account, it doesn't mean like, oh wow, that was a larger than expected move. That's already calculated in. That's what it means. That is when the machines attack. So let's take a look at this. And again, this is, for me, it's frustrating when I don't know about something like this. And then when I do know about it, it's like, the veil being lifted. So these are, as you guys know, I hate looking at stuff, a year ago. So these slides were all taken today. So this was taken today, and it shows the levels that AI would consider within the norm for Tesla on a monthly basis, meaning that these levels stay the same for the entire month of February. Note that for Tesla, this up level is way bigger than the down level. Also note that today, even though Tesla, since all month, this first trading day here is February 1st, while it's struggled here, and it's puked the last 4 days, it's stopped dead here today. And it's pretty amazing because it looks like it's like, oh my God, this thing's going to 600, and it stops dead in its tracks. That's where it's like, oh, this is a move that's outside the norm. Let's go ahead and buy it. So by simply noting the upside levels and downside levels as being unique and independent of each other, this gives the machines a big edge versus regular humans who are relying simply on average true range or Greek calculated expected moves. So this was monthly levels. Okay, so these are the levels that will be here on Tesla for the rest of the month of February. Yeah, so how far, so question is, how far in advance are the lines drawn? Yeah, so these are, this is, and you'll see it gets more clearly, but so this is a monthly level. These levels will stay the same, and they'll just kind of continue to crawl along through until we get to the end of February. And then they'll be recalculated for March, and then there'll be whatever updated levels there are for March. So those are the monthly levels. Now, here we have weekly levels, which means that, and these are some of my favorite, which means that you have levels for the week. Okay, so I'm looking at a 195-minute chart. It doesn't matter actually what time frame you're looking at. It's just that these are the levels for the rest of the week. Okay, so the S&P futures, if you guys saw, they were getting destroyed. They were down almost 100 points overnight. You had news on Ukraine and Russia and all kinds of crazy things happening. But if you look at this, they stopped almost dead on here. And then from there, and from here, they just rallied and rallied and rallied. Now, this was taken, it wasn't by the end of the day. I think I've got another one that shows the end of the day where it did kind of come down a little bit and then it bounced again. And then tonight, we're continuing to bounce. So, okay, so that was the weekly level, but you can also do daily levels. Okay, so the daily levels literally, so I'm on a 30-minute chart here, and these daily levels are good for today. So today only. All right, and there'll be new ones for tomorrow. But look what happened. Okay, so this is the SPX. So it doesn't show the overnight action because remember the SPX only trades cash. The futures were trading down here. SPX rallies at the open, gets here, and gets completely rejected and taken all the way back down, where lo and behold, the market doesn't fall apart. It finds buyers once again. And then it gets rejected here. So this is what I mean, where all of a sudden I'm looking at this and going like, oh my God, this is starting to make more sense. If I'm looking at, different things like, anyway, let me keep going because I get very excited about this stuff and could talk about a lot of nuances that we'll be covering shortly. Okay, so from there, so here's a 2-hour chart of the NASDAQ. I took this literally 15 minutes before I started. So NASDAQ futures, overnight, it got destroyed, right? Same thing. Look at this, for 6 hours, or this is a 2-hour chart. So 1, 2, 3, 4, 5, 12 hours it traded down here. Why didn't it implode? Well, the AI is like, oh boy, this is a bargain here. Let's drive it back up here and unload it. Okay. And as I'm talking right now, the NASDAQ futures are up like 83. Now here's a level I want you guys to write down. Write down 14,200. Because now this is a big if we have some rally and it looks like, oh boy, we're off and running again, that's where the AIs will step in and sell it. Okay. So that's what we want to know in advance. Now, they may sell it and it comes down a little bit and it could certainly rip higher, but initially it's going to puke. It may puke all the way back down here. But the reason this is important is a couple things. One, if you're long something and we get there, get out. It's very likely that it's going to fail from there. And oh yeah, and somebody was asking too, are these different than voodoo lines? So the voodoo lines are definitely different. So this is 14 to 11, right? So here's the voodoo lines, right? So you got 14,401 and then 13,500. So the voodoo lines are incredibly powerful. I love them. And then over here you can see kind of the AI numbers. They're just different. This is something that certainly complements it. It's a little bit more where I would say the voodoo lines is kind of where the big money kind of settles in, and then the AI levels, that's where all the crazy back and forth, what the hell is happening action happens, which is I'm finding the stuff that drives me nuts. So, okay, so all right, so what time frames are they watching? I found that the monthly, the weekly, and the daily levels are incredibly solid. As I said before, monthly levels, they're there for the entire month. It's not like they're changing every day. It means you can plan. Weekly levels are there for the entire week, daily levels just for the day. What gets interesting is if you like to day trade, you could do hourly levels, okay, or 30-minute levels. We'll talk more about this because there's some nuances there that we want to understand. But also what's interesting, believe it or not, the quarterly levels are incredibly important, and it's good to know where they are. Okay. So far, what we've been doing is we've been simply looking at the calculated levels that AI looks at. Okay. Those are the levels that actually the AI is like, okay, we need to analyze this, we need to go back, and we need to come up with these levels. Now, from there, they add a second layer. And the second layer is an automatic one standard deviation away from the calculated levels that were identified. Okay. And I find that while they don't come into play, they do sometimes. They don't come into play as much on the larger time frames. They certainly do if you're looking at it from an intraday perspective. Yeah, so I'm going to start using these in small account as well, because obviously it's anything there where we could actually get a little bit more edge would be obviously huge. We'd all enjoy that. Okay, so as we're looking at this then, here is, dun, dun, dun. Okay, hold on just a second. My computer is wiggling. Oh, that's exciting. I'll switch screens here just for a second. Okay, so that's awesome. All right, let me grab this. All right, so what is it looking at? It is looking right here. Perfect. And then I need to find. All right, got that. It's always good. This is like trading. It's kind of like, oh well, what's happening now? Okay. Now I'm just finding where I was, and bingo. Okay. All right, everybody with me? We should be seeing slide 22, and we should have the excitement of watching technical difficulties in real time. Okay. So, all right. So then what we're looking at is, we have the calculated levels that AI looks at. So the calculated levels that they look at, but then on top of that, they're going to add just one standard deviation. Okay. So now, if we look at this, what we're going to see is that we have the original level, which is here, and then one standard deviation, and then the original level that is here, and then we have one standard deviation. And again, for the larger time frames, the one standard deviation moves don't come into play as much, but I found that they actually come into play quite often on the intraday levels. All right. So I find that pretty interesting. The other thing to keep in mind too, and again, because it's AI based, is that here's the S&Ps. These are the weekly levels on the S&Ps, and again, it's a 195-minute chart, but the time frame is kind of irrelevant. You could watch a 5-minute chart, and these levels would be the same. And again, this is from today, and so we can see that the original level overnight when the market's puked is here, and you'll notice too that from the open to the lower level, that's also the largest amount of points. It's a big move, whereas the up move is a little bit smaller. The one standard deviation up move is smaller still, and whereas the one standard deviation down move is quite large. So while it's still like this dynamic, um, this dynamic reach into the markets. And remember, this is telling us where the machines take notice, and that's what I like about it. It's like, okay, it's not about support or resistance. It's where the machines perk up and say, if you think of a bunch of machines sitting around, they're just bored, and they're like, "Hey, Joe, we're down here. We got to get something going." Boom, they're on it instantaneously. So that's what I like about these. So here is the daily levels. And again, this is the SPX, and this is from today. All right. So what happens today? We rally early. We get rejected hard from the level, the AI quant. I call it the quant pivot for lack of a better term. We come all the way back down to this. We kind of poke through it. Remember, it's rare that we're going to get all the way down here. We'll find out how rare in a minute. Then we come all the way back up here, get rejected, and then so again, remember, the machines are moving this stuff around. Right here, there's not a lot of decisive action, but you can see clearly at these levels there is decisive action, and we want to know where they are. All right, so while the levels that AI scans and take notices of provide amazing insights into the market, what really gets interesting is when we can look at how these levels looked and behaved historically and get probabilities on the levels over however many occurrences we want to study. Okay. This way we can see how they behaved in the past under various scenarios, such as the squeeze, or if they lined up with a key fib level or voodoo line. In addition, the statistics give us the mathematical comfort of knowing the odds of success of a market reaching that level for a target, or once we get there, fading that level because we know it is likely to fail. Okay, so now here is daily the daily pivots on a 1-hour chart on the SPX. So here was our action today. Of course, this is Tuesday, but now we can go back and see, okay, well, how did Friday work? How did Thursday work? What about Wednesday? What about Tuesday? What about Monday? Okay, and if I had the squeeze down here, we could see how it interacted with the squeeze, which we'll look at that too. But if we go back and we look at this, what's interesting is that even right here, where look at this strong up move, all day on Tuesday of last week, we had this huge up move and then we just traded sideways and we ground a little bit higher into the close. Oh wow, no mistake, no coincidence, right? And then on Wednesday, we had this great reversal and we stopped right here, dead in its tracks. I think I remember this because we were looking for the SPX to try to pin at 4,500, but no, it got rejected. And then even on these big down moves, puke, 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 once we get here to that extended level, it basically stops. And in fact, if we want to know how often it closes below those levels, we could come up here and take a look. Now, this gets a little confusing because the green does not match the green and the red does not match the red. It's the opposite. So green, H, is for highs, and red is for lows. So it's a little confusing. You can change the colors if you want. The reason we did it this way is that green is buy, red is sell. And, so I forgot exactly why we did that route, but that's important to understand. So if you look here, here's H2 and H1. So now we can come up here and say, okay, what are the odds that this week it's going to close above H2, which is 43.87? Well, or what are the odds today? Because these are the daily ones, and the odds are just 10%. Okay. What are the odds that it's going to close above H1? 24%, only 24%. So what does that tell us? That means that if we got, say, some kind of a move and we're coming up to this level and we hit H1, get out, because it's only a 25% chance that it's going to be able to actually push through that level. Now, you would think that these statistics are going to be the same, for every stock, and they're not quite. They're close. That's the good news, is they're close. And what I found is that once you kind of get used to the statistics, they're a little bit of a memory hog. So I'll have one chart where I have them on, but then other charts where I just leave them off. Because you can always, and you can always look at them later and stuff like that. But really, it's giving you statistical probabilities. And then other things, like if you want to do some type of a spread in between H2 and L2, well, there's an 81% chance that that's going to work. Okay. So just things like that. And to me, that's nice, because now you're kind of getting some statistical significance about it. And it's not, what's the right term that I'm looking for? It's not based on, like a expected move is one standard deviation. So based on that, there's a 68.8% probability of success. It's not based on theories. It's based on actual. So that's what I love about this, is it's all based on actuals, not theories. Okay, it's the difference between teaching and doing. Hopefully, I guess I'm kind of doing both. But the idea is just that it's based on actual price action versus theoretically what it may or may not do. Okay, so L1 and L2 are price lows, where AI machines are likely to step in and start buying or covering shorts if they're short, while H1 and H2 are price highs, where AI machines are likely to step in and start selling. In my experience, I found that H1 and L1, especially on the larger time frames, daily, weekly, monthly, are very, very strong. But if you decide to go intraday, and we'll look at Amazon here shortly, intraday, because it works really well with this on an intraday level. And I know for some of the people that are day trading it, this actually may help a little bit, because you can use it with, the MACD and stuff like that too. So there's a lot we can do with this. And of course, so the three things that I consider here is that we can just run with the machines, and we can buy against L1 and L2 and sell short against H1 and H2. And that's huge, especially as we see the kind of action that we're getting. Second, we can sell options outside of these levels, especially since they are superior to expected moves. And I'll show you exactly how and why in a second, as they take into account if a stock tends to have bigger moves to the upside or downside. Remember, expected moves are, they're all one and done. Here's the expected move up and down. AI can't operate like that. That's theory. And they're like, no, what's the actual move that we're looking for up, and then the actual move that we're looking for down? And it fully expects that those two numbers could be different. And in fact, sometimes they are incredibly different. Third, we can use these levels as exits, especially with squeezes. Okay, So here is, and let's see, my drawing tool is kind of kaput here, but that's okay. I can use my mouse. So this is something I found to be very common. So here's a 2-hour chart of SPX. Here's a squeeze right here, and boom, here it goes. It stops dead in its tracks at the L2 level, dead in its tracks. So, if you see this and you're in it short and you decide to go to the gym and you're like, oh yeah, this looks great and it's right here, when you come back, almost all your profit could be gone, or worse, or worse, or worse. Um, you're watching the market fall and you're like, you get FOMO, right? And you're scared of missing out. So you decide to short here. Damn it, this thing's running without me. I'm going to short right here. And you get run over like a freight train. Okay. So visually, now that we know what the machines are looking for, we can stop inadvertently getting run over by the machines, John F. Carter. Um, that's awesome. So here's a long squeeze. The long squeeze as well. Um, boom, we come up, we stop dead in the tracks and we consolidate here for, remember, this is a 2-hour chart, for like 6 hours. So it looks like, right? It looks like it could push higher, but it doesn't. It dies. It dies. And so the long, especially if we're holding like a long call, all we're doing is death by theta decay when we should have got out right when it slammed in. And guess what? Right when it slammed in is when you're going to have the maximum IV expansion as well, because it's something, when it's coming down like this, IV expands. And when it also is going up like this, IV expands as well. All right. So that's pretty great there. All right. So the other thing here that's pretty awesome, these are quarterlies. Okay. So these are daily charts over an entire quarter. So April, May, June, right? July, August, September. 3 months, same levels. Now look at this. Couple of important things here. In August, we had this incredible run, August 2020. But by the time the quarter was over, we were back in here. Okay. Why is that important? Because there's only a 9% chance that it's going to close greater than H2. So that means if it pushes above it, they'll keep selling it and get it back below. It's very rare that it's going to close outside of this. It'll happen once in a while, almost never to the upside, once in a while to the downside. In fact, the only 2 times I've seen it do it on the weekly levels, I haven't seen it do it on the quarterly levels, to the downside was March 2020. Okay. And then I believe it happened the 3rd week in January as well, 2 times in a year. So now if we look at this, we see this rally. Where did it peter out at the end of the quarter? It petered out right here. It couldn't go anymore. Where did it get rejected? Okay. The dead high, okay, it's no mistake, it's no accident that the dead high of the NASDAQ was at 16,767.50 right here and just died. That's for the quarter, right? It's the odds of exceeding this for the quarter is so rare that from there it's like, oh wow, we're going into chop mode. Here's another interesting thing. Look at where are we trading right now? We're actually below it. Very similar right here as to what happened over here. What happened by the end of the quarter? We were back in the zone. Very likely, I mean, we could definitely get some more volatility to the downside, but very likely that we start to climb back in here by the time the quarter is over. Maybe this time is different, right? But so far, that's what's been happening. Yeah, so looking at this quarterly chart, does it mean we're going to puke soon? Well, if you look over here, it's like, wow, is this thing going to explode? But it comes back in. So this will be an interesting one to see. We certainly could go lower in this environment. But what's interesting here is that there's incentives for the machines to buy it, and ultimately will they. So while we know that we're under the quarterly level, what's really driving the day-to-day are like the daily and the weekly levels. But I like to know where these bigger levels are as well. Okay, so let me show you. This is a trade that I did in January that I found normally is a setup I enjoy, but it was so frustrating because literally from the very first day I got in it, it stopped work. It didn't work. So there's a 2-hour squeeze. It's great. We're here at 1100. I think we could get to 1150 based on, the stats that I'm looking at. Now, I also know that not every squeeze works, right? Squeezes typically, solid 75, 80% probability of success if everything's aligned. And so I know that they don't all work, but how rapid this thing didn't work really stuck with me. Literally got in it, it fired long, and from there dropped 100 points in the course of like 3 days. And that's when this really got me thinking, did I just buy right into an AI level? And the answer is I sure did. Here's the squeeze. Guess we were? We were at H2. The odds of it actually going beyond that are incredibly low, but the odds of it closing above that is actually low. And in fact, as I was looking at this as a long trade, AI was looking at this as, oh, this is a price anomaly that we're going to take notice of. It's time to sell this pig. And that was a big aha moment for me, is that if I'm looking at a squeeze on the long side, obviously, if we're already at H2, I don't want to take it. Okay. Does that make sense? And the same thing here. If we fall, and look at this here, we get to H2 here, and we die right away. But more importantly, when we push through L2, by the time the week was over, we push back up, and that's really the big part of this. That's where the machines are offering support. So that's the kind of stuff where it just all of a sudden the market made a lot of sense. Yeah, the white line is very easy. That's just where it opens. So it's a lot of this is driven by the Monday open, or of course, in the case of this week, the Tuesday open. So what the AI found is that the opening price is key, and then all their levels are then based on the opening price. Like, okay, if it opens here, here's the potential upside it could go. This is where we're going to get interested in fading it. If it opens here, this is how low it could go before we get interested in it as well. Okay, now, so instead of unknowingly fighting AI, I decided to start trading with AI to see what would happen. So on January 24th, this turned into my first $1 million trade of 2022. And I want to make a note of this because I have found, especially, the last couple of months of last year, going for big trades was not only stressful, it was, you're putting on a lot of risk. In this particular case, I didn't necessarily put on a huge trade. I just caught a huge move. But I would be very, very happy to grind out, I call it that 2.5% a week. So I look at this as kind of like, hey, I'm not mad that it happened, but it's not my main priority by any stretch. So what happened here? This was on that day on January 24th. The S&Ps puked on Monday. Again, we got the weekly levels. And then on Tuesday, they came down to L2. Once I saw that they were coming in and the tick started popping up, we bought it, posted it in the room. And what I didn't know is how far the S&Ps would go up. And they just kept going. And so that was something, once we got up here, it was just a ridiculously huge move. And so I'm not going to complain. I don't expect that to happen all the time. But the main point is that when I saw that after how ugly this was, buyers started stepping in here, i.e. the machines, I felt comfortable moving with them. And that turned out to pay off pretty big. And then you can see again here, we had this move up, and then by the end of the week, it came back into the zone. That's something that happens quite a bit. We gapped down and we closed in the zones. Another move here. Let's get up here. Oh, it looks great. It's great. Puke all the way down, but it doesn't go beyond that. Strong week, tough. Look at this. Rejection, and puke. So that's the kind of stuff where I find it fascinating because it's like, gosh, it sure is choppy here. No, the AI just keeps selling the crap out of this. Right. And so that's the part where it just gets more interesting. Yeah, and we can look at some stuff too, like Google and stuff like that too. All right, so here's a couple of trades. So Apple, this was an iron condor we did in Apple. Why did I want to do this iron condor? Sold, 100 contracts 4 times, a little credit, and went to max profit. Like we closed out the short side for like a nickel. So why did I do it? Well, I had the weekly levels on Apple, and I could see that, here was the calls that we sold, and then I sold L2. So we sold L1 calls, sell L2 puts, obviously did it as a spread. And guess what? We bounced off of this, and it was a pretty easy trade. In fact, it was one of the easier trades I've done this year. And it's like, oh, maybe I should pay more attention, more attention to this, right? So another one. Now this is another thing I was kind of looking at, and this was a trade from last year when the squeeze ran out of momentum. This was back in July. We actually did some shorts, and I was just looking for a short back to the 21 EMA. It's very common once the squeeze is over, we revert back to the mean. But, it started going pretty heavy. And if you go and you look at the levels here, you can see we actually went all the way down to L1. We pushed through it, but actually found support there before we bounced. And so again, the idea with this and the goal of this is that we can see like, oh, it's had a good run, it's stalling out. Where could it pull back to? And that these levels actually come in handy with this too. And on this trade, we did, puts on the S&P futures. We bought at 16, sold them at 54. Sold a call credit spread. And then this is a strategy, and we'll do more of this, especially in small lot in the room. This is insurance. What if it doesn't work out? The insurance was only 75 cents. So if I lose all that, that's fine. I'm covered in case, something happens. And then this is Amazon. So these are the 2-hour levels in Amazon. And so I know for a lot of folks, they like to day trade Amazon and they're doing the hook and all that kind of stuff. And I thought this would be useful. So here you have the 2-line MACD. And then this was from today. So all this is today's action. This is a 5-minute chart with the 2-hour levels. So today we got to H2, and then you saw the MACD hooked lower. Guess what? Boom, 20, 30 points. Nothing. And then we came down to L1, right? Boom. We got the hook higher here, 20 points. And then at the end of the day, we were sitting there farting around at L2 again, updated level. Boom, we hook lower and we puke. So I find that, if you are day trading and you've got something that you're looking at, a level like this helps because you can help anticipate, oh man, this thing's probably not going to be able to get through this. Let's look for the hook lower. So a big part of this in terms of consistent trading is learning the rules of consistency. And again, this is kind of like part of this is me talking to myself where it's like, all right, no, let's go for big trades. Everybody likes big trades. But at some point, it's not about like, oh my God, let's try to make a big trade. It's at the end of the day, trading is a skill, and it's more important to be consistent, even if that means it's a bunch of small trades. And I mean, and it sounds funny. I know it's just like, I sometimes like, I kind of get that thrill of the chase. Like, okay, guys, let's try to find another big trade. A, that's been very difficult in this environment. B, who cares? At the end of the day, if you do get consistent and it's 2.5% a week, that triples your account if you're not wiring anything out. So really for me, it's just getting dialed back into that, utilizing these levels to kind of help with that as well. So the idea is that you don't want to eat like a bird and defecate like an elephant. So this means that with this kind of strategy, what's nice is because the entry levels are so clean, the stop losses can be pretty tight as well. This is not something where it's like, oh my God, we got to have a 2 ATR stop or anything like that. You can actually get pretty dialed in. So I call this managing risk. So when I ride horses at our place, yeah, it's kind of dorky to wear a helmet, but guess what? If he gets upset or sees a snake and throws me, if I land on a rock with my head, I'm done. I'm not trading. I might not be alive anymore. But it's things like that where it's like, we want to be able to manage risk, and especially when you're on top of a 1,500-pound animal that might get scooped or might get spooked. And what I found is many traders, and look, I'm throwing myself in this category too, have been focusing on the wrong things. Many traders have no idea that the machines have taken over the market. And this blindsiding isn't deliberate. It's just the machines playing a game that not everyone is necessarily aware of. Jonathan, how do you know where to set your key levels on your indicators so that they match the same key levels that the quants are using? Well, so if I understand your question, let me bring, that's a good question. Let me bring this chart over. It's really weird. My 6-monitor setup, one of my monitors went out, which is really annoying. As I got my new Falcon. I just haven't, it's been a lot going on. So I'm just trying to get that set up. So over here, so what I'll probably, John, do is something like this, where it's like, okay, here's my squeezes. I want to look at the squeezes with these levels, right? And then I can still over here and see, okay, where are the voodoo lines, different things like that. I'm still playing around with this, but I do like the idea where, I might have some standalone charts. So I can look at different things where it's just like, okay, here's the NASDAQ. What are the levels there? But then, I also want to incorporate it into if I'm using the squeeze or moving averages and things like that too. So I'm still, that's, so I think if that answers your question. How does this approach explain the huge gap downs in earnings? So it's a really good question. Let's look at, and the answer to that too, a lot of times can be that earnings can be anomalies, but let's look at, like say Tesla real quick. And I want to come over here and to say, okay, let's go to studies, make sure that that's the daily. So for earnings and stuff like that, it's more about like, okay, what are these monthly levels? And we've got to then look at the daily chart because I want to be able to go in and see when the earnings were. And by the way, for stocks, I do not look at extended hours with this. That gets a little goofy. And I think I've got corporate actions on there already. Let's see. Yeah, there we go. Okay. So here's Tesla, right? Tesla has earnings, they get crushed, and they actually fall below and come back in. Okay, so what about Google? Google had this huge gap, almost got to H2, and then got crushed. What about Facebook? Now, Facebook, again, it happens, but it's rare. But this was a 4 standard deviation move. So for earnings, it blew right through it. So for Tesla, it worked out fine. For Google, it worked out fine. For Amazon, let's see how it did with Amazon here. Yeah, there's the earnings. Boom, we get close to the L2 and it gets rejected. So even with earnings, a lot of times, especially the upside, it's coming in play. All right, so remember that the blindsiding is not deliberate. It's just the machines playing a game that not everyone is necessarily aware of. Okay, so a couple more points I want to make here. So here's the SPX. I took this 15 minutes before we got together. The expected move for the rest of the week, 3 days, is $92. That's what the market makers have priced in. Okay. However, the AI, which is based on actual and not theoretical. Okay, it's based on actual, not theoretical, has different levels. Now, what I find on something like this is it's almost an arbitrage opportunity. These options are pricing in a $92 move up or down, yet the L1 level for the upside is 57 points, and then, or H1, and then L1, which is down here, is 64 points. So when I look at something like this, it's kind of like an arbitrage opportunity. The market is pricing in a $92 move, but the AI machines are ready to act on a $57 move up and a $64 move down, as they did today. Okay. This also presents some really interesting opportunities. And then let's see. So the way to take advantage of this is first be aware of it and understand what this means as traders. So yes, we can jump in and out whenever we want. We're small traders. We have liquidity when compared to institutions, but it's not an edge if you don't understand the rules of the sandbox. The thing about AI is that we have reverse engineered their levels and we know where they are. Bringing in this inside knowledge based on what the other side is doing, we can systematically utilize that by trading in their blind spot, i.e., they're not going to come after us. They don't care about us, but we know when they act and we can kind of play with them. So I always, anytime I'm looking at something without this, it's like, okay, who's excited about trading against a $14 million computer? Well, I find that it doesn't work for me. And I would rather certainly trade with it. So at the end of the day, machines are programmed to take action when the price of an index or individual stock moves outside of typical norms as defined by its own research, not ATR, not expected moves, by its own research, because it's able to go back and look at all this stuff. This started off as hedging activity, and then the machines caught on and started trading around those levels. Okay, and not just normal machines, AI machines. That's why this is so different, which begs the question, why trade against them even unknowingly? So the markets are designed specifically to manipulate our minds and get us to chase moves when they're about to end and hold on to losing positions too long. In this type of environment, this will be multiplied by a factor of 10. Hopefully, it was a big aha watching like where even squeeze moves terminated almost to the penny. So it may sound complicated. The good news is you don't have to know anything about options to do the strategy. You could certainly do it, buy the spiders, as a stock, or simply do a call or put if you want to kind of take that next level. So it is a great strategy for newer traders, even if you have a small account, if you're looking to be on the same side as the machines and not get frustrated in this environment. Someone asked too about Bitcoin. Yeah, so for Bitcoin, same thing. Remember, AI is in there too. Guess what? We come down to L2, let's buy it. We come up to H1, let's sell it. So even though Bitcoin, which is the symbol of independence and freedom and all this kind of stuff too, AI is trading that too. Remember, the machines are they can do everything. They don't get tired. So as long as we know, and it's not like they're going to stop a major trend. It's just that the pausing points and the frustrating back and forth along the way is what they're doing. And we can trade with that, is what's great. So you don't have to do anything crazy. You don't need to do naked options or anything like that. And I can always walk you through, if you're new to this, what you need to know. The one thing I talk about, I've talked about this before, why 2.5% a week? And it's important to understand, and I remind myself of this because it's like when I'm going for home runs, it's like, Carter, if you would just calm down, trade smaller, use the levels, and grind out 2.5% a week on average. If you start with $100,000 by the end of a year, you're at $361,000. Now, obviously, it's not going to be exactly 2.5% every week. Some weeks it could be down. Some weeks it's going to be up 5%. But if it's important to understand that this is why it makes so much sense to cut losses, because you don't have to make a lot. If you got a $100,000 account, 2.5% is $2,500. You can do that on a 10 lot put credit spread. You don't need to trade 25 times. And I think this is it's important to look at this to understand how important it can get. Just a little, it's like compound interest on steroids, because it's compounding weekly at 2.5% versus annually at 1/4%. Compound interest is a miracle, but it's a ripoff if you got your money in a bank. And why consistency and not home runs? Because in order to grow an account quickly and consistently, a trader must learn how to get into this groove. Obviously you want position size and limited risk, but in this case, it's also understanding what are the machines doing, so I'm not fighting against them. So at the end of the day, I'm a trader. The markets can be frustrating at times. They have been frustrating, but the key is to adapt, not give up. I joke that this would be way easier if I was just trading on my own, because my life would be way easier. I would just be trading. But I enjoy I guess putting it on the line. It's like, look, this is what I'm doing. If it helps you, great. And if you find something better, that's awesome. And I'm certainly not a professional teacher by any stretch. And I'm not a huge fan of like, oh my God, let's sell this. But I'm very passionate about what I do if it's helpful. And it's like, okay, is this helpful? Is this useful? Is this going to make somebody's life easier? Is this going to make my life easier? So the idea with this is like, hey, are we ready to trade with the machine? So I want to stick around and answer questions. But before that, I want to let you know that I'm going to be doing a class with this, and it will include the tool. The class will be on March 5th. We'll be live trading March 22nd and 23rd.
and then the 30th and 31st to give us plenty of time after the class to kind of play around with it. So the idea with this is for, I think, a reasonable investment of $597, we'll go through and do an entire strategy together on how to do this. Obviously, there's a bonus install session, and then you get a copy of the tool. Someone was asking the difference between this and, gosh, in 2017, we'd done something where it was a bi-weekly wires. So there's a similar concept there. This one is got, you can do yearly, quarterly, monthly, weekly, 4-day, 3-day, 2-day, daily, 2-hour, 1-hour, 30-minute. You can go the whole gamut, and basically you're looking at the same time frames that all the AI is doing too. The other thing is cool is that you can certainly, if you've got a chart that you like the squeeze, you just overlay it on there. And so I found that something like that has been very helpful too. And it's kind of like, oh, here's a squeeze. Great. Well, guess what? It's really not going to go much further than that. And that's, so what you'll notice is when I'm doing trades, they're going to certainly have much, targets that are going to be lined up with that versus like, oh no, let's see if this can go to, 3 ATR or whatever that is. Is this different from the voodoo levels? Yes. So they're absolutely different. It doesn't mean that they're better than voodoo lines. Okay. So if we look at the NASDAQ here, we can see that the tree line here is at 14,440. The tree line here is currently above this H2 level. So what that tells me is that we ain't going to get there this week. Okay. So if you're long and you're hoping we're going to get there this week, the odds of that happening are pretty low because we've got all this in front of it. And so I love voodoo lines. They're great. They're there all the time. This is kind of like why did the NASDAQ stop right here and not go to the snow line? That's the kind of stuff where the AI comes in. And so I think they complement each other actually very, very well. So that's that. And then, so again, real quick here, if you go to simplertrading.com/wire, it will take you to a page where you can kind of add to cart. And, to me, if this was intriguing for you, the basic is a no-brainer. I think this pays for itself on the first 3 trades that you do with it. But it also gives you an inherent understanding of what's happening in the market. So you're not frustrated or confused. In fact, you can just kind of kick back and wait. Like, oh, here it comes. I wonder how many people this is going to fool this time around. And then, of course, if you like to do live trading, the live trading, what I like about the live trading, because people ask, well, why do live trading with it? And it's really just a sense of like, hey, we used to do mentorships where like 5 people would come and sit at my desk for 3 to 5 days. And it's just harder to do. It's just, now with the internet so strong, you get, people surrounded with laptops, we're crowded on a desk, we all start to smell after a while. I miss the camaraderie because it's fun, get to know people and stuff like that. But, it's just easier for everybody to kind of be on their own computer. And you got your own setup and you can get some water, that kind of stuff. And so the idea with this is the live trading is kind of like the mentorships that we used to do, where you can just kind of look over my shoulder, trade with me, see what I'm looking at, ask questions if you've got something that you're looking at. And it's how you learn to trade. It's how I learned to trade. I learned to trade with mentors. You can read a book, like if let's say that you've never played golf before and you get invited to go to a foursome, and over the weekend you're nervous, so you read 3 books on how to play golf. And then you go to tee up. I mean, how is your swing going to be? It's going to be horrible because you haven't practiced. And trading is a skill. You can read every book on the planet, but trading is a skill that is developed because you got to understand how you react under pressure. Do you know how to execute the order? Do you know, when to pounce and, when to stand aside? And those are things that you learn only by doing. Just as when you're playing golf, you learn to hold the club only by swinging the club and seeing what kind of result you get. So it's the same thing in trading, and that's why I like to do the live trading. So you can do 2 days of live trading, or if you want to do 4 days of live trading and tack on an additional 2, you can do that. If you're not sure, if you're interested in the indicator and you're not sure about the live trading, then just do the basic. You can always add these later. Okay, so if you go through the sales page, this will kind of give you a little bit more information. Again, just go to simplertrading.com/wire. And the tool that you will get is, of course, this tool. And once you start looking at it on the screen, I think you're going to breathe a deep sigh of relief. It's like, oh my God, the markets finally make sense. Live trading, and there we go. Okay, so I'm happy to stick around for a little bit. I want to respect everybody's time. Let's have this wrapped up in the next 10 minutes or so. But I just want to see if there's any questions. Is there anything you'd like me to look at? I think you guys will really like this. I'm excited. I don't like it when my trading is hard because I know if people are following me, then that gets frustrating for them too. And so I'm excited that it's like, oh my God, this, it's like make trading great again. Yeah, okay, so good question. How is Simpler able to replicate what a $14 million computer was? So to be fair, the tool is not analyzing thousands of charts at once, right? And it's not telling us what we should do. So that's what the $14 million computer does. What we have is the inputs where we can say, you know what? I know you're going to look at 7,000 stocks on 7,000 time frame, well, on 5 time frames, and I'm going to look at Amazon. So that's the trade-off there. The tool will not analyze every stock on every time frame and then tell you what to do. That's what AI does. However, we can look at stuff that we like to trade and actually just have the levels. We can't look at 1,000 things at once. We got to pull the trigger. Does that make sense? So that's why he wasn't too worked up about it. Let's see. Yeah, do you want to look at TTD? Yeah, so TTD, you can see that it kind of TTD has kind of come back to the mean, and you can see it's just kind of hanging out right here. Obviously, I'd love to see this thing kind of get its act together and work back higher. Someone was asking earlier about Google. Let me get the other chart so we can look at the. Let's see. Okay, so I'm just gonna squish this a little bit so you can actually see the packages. And there is the website. There's the link. All right, so I'm going to come over here and just stay. All right, I want to look at, yeah, let's look at the weeklies. Yes. And then let's change time frame to 2 hours. Okay. So, okay, that's Bitcoin, of course. And then if we say, okay, what about Google? What's Google doing right now? And again, remember, these are the weekly levels, not the monthly. And so we can see that, Google, came down right to its L1 level last week, and we're just kind of still sitting at that area. I think this week, if we get a bounce, it gets to 2664, and that gets rejected. So tradable bounce, but I would sell it there. Yeah, let's look at copper. Let's look at copper on the bigger levels. So again, weekly levels, and you can see we're just kind of trading sideways here, right? So a couple weeks ago, we got up to that H2 level, got rejected. So you can see they're in here too, right? They're in all markets, by the way. They don't just trade Tesla. They're in all markets. That's why Bitcoin, everybody kind of reacts to it. LE, yeah, let's look at LE. I think it'll automatically populate that. So yeah, so you can see here, been a good run. We pause, here's a high, and now we're just kind of, we're kind of sitting in here. And for stuff like this, I mean, I kind of like to look at slightly larger time frames, meaning levels. So like the month. But one thing you can do, so if you don't want to look at all the past history, you can say show all periods no, hit OK, apply, and now you're just looking here. So that's the monthly level. And then if you want to say like, well, I want to see the weekly level too, you can add an additional instance of this, right? And just say, okay, there's the week, and let's say I don't need to see all the periods, and I don't need to see the stats. So just kind of keep it a little clean. And so now what gets interesting is you can say, like, because you can see here's the levels for this week, and then you got the levels for this month. And so you got things like that then things can get kind of interesting that way. So if we look at, say, the NASDAQ like that, we can see that we're sitting here at that weekly level. And then the monthly level, the monthly L1 level, and then the weekly H1 level line up. So high likelihood that that's going to get tested. So stuff like that. So there's things like that we'll play around with during the Saturday class, where you can kind of, it's kind of cool. No, so Danny, good question. So how will this affect the AI fund? Because now it's kind of like we're using their levels, so they don't care. I mean, I asked them about it, and it's like, because remember, they're looking at thousands of stocks, indexes, futures, multiple time frames. The AI is trading automatically. They're not. For us, we're going to look at it on three things. We, as a human, we're going to be like, oh, I'm going to look at it on the NASDAQ, the S&Ps, and Tesla. That's all I can look at. I can't look at 100 things, and they know that. So, and a lot of us trade the same things. We're all looking at Google, we're all looking at Amazon, and it's, if anything, it will help enhance the levels. No, so the expiration cones, I think that's what it's called in Thinkorswim. So that's based completely on theoretical expected moves, and none of this is based on theoretical. What is the smallest time frame you'd be comfortable using it on? So if we drill down here and let's let's change the monthly levels to first of all, let's try 30 minutes. In my opinion, let's do no on the stats. 30 minutes is going to be, it's going to be tough. So if we look at the 30 minutes, did they even show up? Let me move this over a little bit. So 30-minute. Oh, duh. I gotta set up a smaller time frame. So let's say it's 30-minute levels. I'm gonna do a 5-minute chart. Okay. So here's the 30-minute levels, and of course it's trying to incorporate everything now. So if we look at this, and this is on the NASDAQ, let's do it on a stock like Amazon. Yeah, no. So good question. Are these going to get updated often like Voodoo lines? So you don't have to. Yeah, it's yeah, you don't. They're good to go. So you'll notice here. So 5-minute chart, 30-minute levels, and so you'll see that contained in this 30-minute time frame, we do stay mostly in, and it pushes through a little bit here. And here you can see it kind of stays in and stuff like that too. Personally, I've found that the 30-minute levels are a little loosey-goosey. I have found, though, that 2-hour levels are pretty solid. So if you're looking for some type of kind of more day trading, the 2-hour levels, for whatever reason, they're pretty solid. So here's Amazon. You can see the 2-hour level, just like a iron fence right there, right? And so I found stuff. So I found that pretty interesting, and we'll go through this during the Saturday class. What kind of levels and stuff like that. Technically, you could look at 1-minute levels, but I do think that the smaller the time frame, a 5-minute level, I don't really think it's worth it, and I don't. And from the AI guys, they don't really mess around with that. So we want to be in zones where they're playing. We don't want to be in zones where they're not playing. All right. And then also too, just kind of keep it in mind. What's interesting here is if we change this to, let's change this to quarterly. And we need to update this time frame to like 2 hours. And then all of a sudden it's like, oh, wow, look at the quarterly levels. Now, again, they're not going to come into play very much, but on Amazon, we came down to that lower quarterly level. It's like, why didn't it collapse from there? And then, here before earnings too. So that's the kind of stuff I find fascinating. It's truly an area where AI spotted an anomaly and stepped in. That's it. It's not like, oh my gosh, and you could see it kept getting sold and sold and sold, but there were more buyers there. So when do the levels change? So, okay, so a quarterly level updates every quarter. So starting April 1st, these levels will change, and then you'll be able to see the old ones. And then the weekly levels update every Monday at the open. The monthly levels, the first of every month. If you are looking at 2-hour levels, literally every 2 hours they'll change, and then you can see what the old ones were. Yeah, and it's always like some interesting, on the spiders here. Let me get rid of the fibs. So can we see them? And again, the quarterly levels, of course, these have been here, all quarter, boom, boom, boom. But then if we look at, say, okay, well, what about, I'm going to change these quarterly levels back to the 2-hour, kind of smaller pivots. Does this something, do the spiders respond to this? And now I got to drop the time frame down. And, again, you can kind of see, again, 2 hours for me for the indexes is a little low, but, they respond. They certainly respond. I'm a huge fan of the daily levels on the indexes and then the weekly levels on the indexes. Yeah, so my favorite time frames, the 2-hour levels are pretty legitimate. The daily, weekly, and monthly, though, you can tell the AI steps in there is the thing. Like, it's no doubt. And so the smaller time frames, especially, the 2-hour is actually pretty good too, and especially for quicker trades. But the thing about the daily, weekly, and monthly levels, and even the quarterly, but of course the quarterlies, those are big levels. They're not going to get tested every day. Is you can actually see it on the tape. Volume is coming in at those levels. The machines are taking notice. Yeah, so what would I use with this? So believe it or not, I mean, this doesn't, on something like this, it's not like, oh my God, throw away everything else. The squeeze with this is great. If anything, the squeeze, it's kind of like, oh, I got to squeeze long. Guess what? Guess where I'm getting out, right? RAF and all that kind of stuff too. And I'll, as I build out, I'm updating my charts with this too. But things like that are, it's very, very, very complementary. For swing trading stocks, what is the best combo? So for swing trading stocks, if you're doing swings, I would go with weekly and monthly. So let's go monthly. Show statistics, no. And then I'm just going to go no here so we don't have a really busy chart. And okay, so it's weekly and monthly, so we can go to a daily chart. Yeah, let's go to a 195-minute chart. Again, the levels, keep in mind, the levels don't change, right? When you change time frames, the levels don't change. So now we've got that. And then let's look at, gosh, what was a stock I was looking at? Netflix. No, it wasn't Netflix. RTX maybe? Yeah, so RTX. So here we had a move higher, and look where it petered out. We got that monthly L1 level, and since then it's just been, trying to pick up steam again. And so it's just things like that where, as you're looking at this and going like, wow, did you buy it at 96.96, or did you know that this is a level that would be defended basically? Now, the next time it goes up there, it could break through, but typically, especially the first test, AI is stepping in. The machines are stepping in. Yeah, so good question. So how does this relate to the Keltner channels and like the 21 EMA? So, again, it doesn't mean I throw the baby out with the bathwater. It just means that it's taken into account. The main thing to take into account here is that what I find is that this gives me a healthy overview of, what's the market. Oh, we came into, plus 3 ATR. We're probably not going to get through, we're probably not going to get too far through that. But the machines don't care about that. So it's the thing is that the ATR can kind of help us with stops and managing risk. But if we're really interested in when the machines step in, that they're looking at these levels. And so that's how I look at it, as the levels just kind of give you a snapshot of the sandbox that the machines are playing in. And we can use those and see where they, where do they line up with some of this other stuff that we're looking at. What we know is that the move, like a 21 period moving average, attracts human traders. Does it attract AI? By itself, I don't think it does, but those levels do. Yeah, so good question. So for futures, and by the way, I think I mentioned this, but for stocks, I do not look at overnight data. So I only look at the cash session. I've tried overnight. It doesn't, it's ugly. It doesn't, because the overnight action is weird. It counts that as the open. You could get some weird low volume kind of stuff. For futures, the open is kind of like right after the settlement. So I will double check. I believe it is that 5 o'clock open. Different AI machines may use different parameters. Yeah, so that's a good point. So what I found with this is that AI really thrives on actual versus theoretical. So what we're using here is actual. And AI could certainly look at it from a different vantage point. But what's interesting is that when you watch this stuff, you can tell things are happening around it. That's what's crazy about it. So anyway, all right. So that's what we got. It is 8:33, and I wanted to wrap up by 8:30. I know we all got things to do. As a quick kind of a final nod here is that, here's the link, simplertrading.com/wire. And then again, for the 597, we're going to do a strategy class together Saturday, March 5th. Included in this class, of course, we're going to be going through all the stuff, all the different setups, how to use it, all that kind of fun stuff. And of course, it does include the tool, which is awesome. And then we'll do a bonus indicator install session if you're not really sure how to do it. I always say, like, if you've got, like, say, Fidelity, and you're like, wow, I like this, but this doesn't work for Fidelity. What's the nice thing about Thinkorswim is you can open up an account, put $100 in it. There's no fees. They don't charge you a monthly fee. That $100 is yours. I think you could even take it out. But then you could look at charts on Thinkorswim, free, real time, and still execute on Fidelity, on E-Trade, wherever you want. For whatever reason, Thinkorswim has just been really easy for programming this kind of stuff. And of course, we're always looking at other things too. I mean, TradingView, TradeStation, all that too. Looking at that as well. All right, guys. Well, thanks again for joining. I'll leave this page up. If anybody has any questions, we'll be hanging out here. Otherwise, anyway, hopefully this makes your life a lot easier in terms of the trading world for 2022. I know just from me kind of starting to use it, looking at it, it's been a big relief, which is great. And looking forward to seeing you guys tomorrow and continuing to answer questions, and we'll get this thing going. You guys and gals have a fantastic night, and we will see you tomorrow.